that was the plan, to get that view out into the market, then it's worked. So in theory, we're priced for the 75, but the message is going to be very important. As you say, is this going to be a 75, but we're just getting ahead of things, or is it a 75 and we're going to carry on and it's going to be a hawkish message? I think it's the latter. I think Powell is going to come with a 75 and a very hawkish message. They're worried about inflation expectations getting de-anchored. Not only do we have that CPI on Friday, we also saw the rise in inflation expectations as well. They're very worried about consumer inflation expectations. That's why the message is going to be a tough one, I think.
Lee, we know historically, in recent history, life on cable around 120 is not sustainable. Life on euro dollar around parity is not sustainable. Lee, how important is the FX channel, and how do you think this is going to play out through it? As the Fed looks to go big, the ECB and the Bank of England look set to respond.
Yeah, I think everyone's trying to pick a top in this dollar move. And from a valuation point of view, I can see it from how far we've moved. I can see it as well. But the fact is, look, we're in for a tough couple of months in markets. At the same time, you've got stubborn inflation. It went up even further. That's not going to show signs of easing anytime soon, we think. At the same time, the real economic data is deteriorating, and you've got a very, very hawkish Fed. That's a really bad backdrop for asset markets. And when equities sell off, you want to be in the dollar. That's the bottom line. People keep wanting to pick a top in the dollar. We saw it in May, and they got their fingers burned. And this is going to carry on being the trade. For me, you've still got to stay long of the dollar. I agree with you at cable at 120. You know what? But Jonathan, we haven't been through Brexit before. We're not starting to see what we're seeing now. The data out of the UK is getting really, really worrisome. And yes, the Bank of England will want to respond in kind, but they're in even a tighter situation than the Fed, quite honestly. So I can see cable carrying on going lower. 120 historically, yes, but we saw 115 in March 2020.
Yeah,
I can get us below that.
How much confidence, Lee, do you have that Italy will have some sort of containment of those yields, that the ECB will come out with a plan that will actually create some calm? Would you be shorting Italian bonds here, or would you be buying them?
They'll come out with something eventually. Whether they do it today or not, we've seen this in the past with the ECB. They recognize what the problem is, and they try and tackle it in a sort of, a minimal way if they can. And then eventually they're forced to doing something more dramatic. I suspect this is the first of the stage of trying to tinker around the edges. And then if the market continues to widen, the spreads continue to widen, which I think has got to be a real risk, we'll see more down the line. I still think we'll get there. Right. We've seen it before.
Euro weakening now, halfway back, even more than halfway back to where it was at 1 a.m. this morning over ECB emergency meeting enthusiasm. Lee Farage, you spent over a decade in the trenches of Treasury at Rabobank. You have lived EU banking and their linkage to bonds. Yet they've never seen bond price declines like this. I don't want you to speak for Rabobank or certainly State Street, but how do you view continental banking and bonds given these abrupt moves in price?
As I said, the ECB will get there. They will control it. We've seen this in the past. How many crises have we been through where we worry about the periphery? You go back to Draghi and whatever it takes. We had a similar comment this morning from Schnabel that there are no limits, and they'll get there. They may not get there today, and we may see these spreads widen further, but the ECB will come up with a plan, and they will control these spreads. And the fact is, listen, if you don't think that Italy is going to leave the Eurozone, which I don't, then 4% yield, it's not unattractive. You get a 4.5% maybe 5. That's not an unattractive yield. At some point, buyers will come back, but the ECB, as I say, they will come out with a plan, maybe not today, but they'll get there. We might have more pain in the interim, but they'll get there. We've seen it before.
Lee Farage, thank you, sir, of State Street on a range of issues, maybe a sub 115 cable move as well. Wow. Lisa, the ECB, and we talked about this before we came on air just for a minute, it's easier to address these issues when inflation is low. When inflation's at 8%, to address fragmentation, so-called fragmentation, that's a lot harder to do.
How much did the soft landing scenario entirely rely on inflation data cooperating, which is out of the control of a lot of these central bankers? Without that cooperation of inflation, as you say, that is not high, how do they achieve threading this needle that seems contradictory.
I keep trying to go to this, and I'd love people to write in on a Bloomberg, on Twitter, wherever you like. This FX channel is so important. When you hear these people talking about imported inflation, not everyone's going to win that FX game. And I keep looking at these moves, and if I was the ECB, I'd be really worried about not just what's happened in Italy, but what happened in the FX market as a consequence. Because the last thing you want is this doom loop between what happens with monetary policy, the bond market, and the currency going the other way, which is what the Bank of England faces too. And so far, this stronger dollar story, Lisa, maybe that does start to take a bite out of some of the inflation story for America, but for Europe, they're facing a weaker currency. For the UK, they're facing a weaker currency. That exacerbates the problem, which is why you and I have gone over this issue so many times over the last few months. The currency moves, are they positive or negative in response to higher interest rates of the ECB and the Bank of England? And at the moment, we're finding out. Just getting a couple of lines from the ECB, comments in a statement following an emergency meeting. The pandemic has left lasting vulnerabilities in the Eurozone. That's the first line crossed on a Bloomberg. I'm waiting to see that statement on the ECB website. So we are getting a statement. They will apply flexibility in reinvesting PEP redemptions.
What does that mean?
That's one line. Looking for a little bit more detail here. The ECB instructing committees to prepare a new crisis tool. Can we get the Italian 10-year? And I would say, get rid of this commercial break, get rid of what we're about to do, sit on this story, dial back the music, and let's talk about this. The ECB instructing committees to prepare new crisis tools. Lisa, to me, at first look, and I want to go through that ECB statement, I don't see a plan here. I see a plan to make a plan down the line.
Well, this sounds very similar to what came out with the ECB meeting, where they said that they were going to maintain flexibility. You did see a knee-jerk reaction a little bit in the BTPs, yields fluctuating around. But honestly, this is underwhelming at a time when people were looking for details. Without details, they could sit in a meeting. They knew this was a problem since June 9th. The fact that they really haven't come up with anything other than very similar language, John, is indicative of the conundrum that they're in.
Yields coming back a little bit, Tom. Still working our way through this. The Italian 10-year, 382, down 35 basis points on the day.
Yeah, I'm looking for the statement here, John. I think I've got it coming up here now. The gerbil's working. I didn't pay the bill on the Bloomberg.
I've got the statement,
I've got the statement now in front of me, and it's a short statement. Let's start with that. Based on this assessment, the Governing Council decided it will apply flexibility in reinvesting redemptions. We knew that, excuse me. They're going to mandate the relevant Eurosystem committees together with ECB services. You know, I had Dr. Regling with me in Davos, John, who's the architect of emergency actions, and I wonder what Klaus Regling would say, probably removed from this statement.
And this is a really, really tough one. And what we're seeing in the Italian bond market is things slowly, as we start to work our way through these headlines and this statement, turn around. So today we had yields aggressively lower off the back of this idea there would be an unscheduled meeting. They would look to address some of this fragmentation concern, and yields are going the other way now. Still lower on the session by a whole lot, by about 31 basis points on an Italian 10-year at 388, but certainly moving in the wrong direction, Lisa, again off the back of this.
It's underwhelming. They need to come out with a plan. This is not a plan. This is reiterating that they're going to, as you said, John, come up with a plan. How do they even craft one at a time not only of political dissent on all sides, but also when they have to tighten financial conditions enough to suppress inflation if that is their goal? Otherwise, what is their goal with this tightening plan that they have?
The challenge you have right now in this bond market, though, Lisa, as we start to erase some of the gains in the Italian 10-year, is how far do you want to push this again, knowing that they are trying to come up with some kind of crisis tool? Do you question their ability to come up with one, something that would be effective? They've talked about no limits. Can they come up with something without limits that can address so-called fragmentation and simultaneously raise interest rates at the same time? Ultimately, the market is going to be the judge of this, not us, and yields are turning the other way. But I wonder how far you would be willing to push this, Lisa, as the ECB has set out this morning to say we are preparing a new crisis tool.
And Lee Farage was saying, don't fight the ECB. They will eventually find a way, and so he wouldn't bet against them. But this is the reason why, as you were saying before, the existential crisis of the euro, this goes to the cohesion in the euro area. If you do have this concern about a member state, but what is the political dissent within the ECB and frankly within the European Union that pushes back and says it's not our job to take care of a country and their finances. On the flip side, they've been doing it for a long time. And so at what point does that cohesion really take the dominant force?
Happy to say that standing by is Maria Tadeo out of Brussels. Maria, you've read through the statement too. Your take on what's developing in Frankfurt, Germany this morning?
Well, you know, to your question and consensus, you don't put out a statement like this. Frankly, you don't call a meeting like this if there isn't consensus. And what is clear is that the Governing Council has now agreed, and this is what the market wanted, and they put it out on paper, that they will accelerate the completion of a new tool that is designed to fragment or to deal with the fragmentation in the market. This is basically what investors out there, particularly in the European market, wanted to hear and had been wanting to hear for a week now, that this is not just an abstract term, that the European Central Bank will fight fragmentation in the context of rate hikes, but actually put it on paper, something concrete. I think it also goes beyond the initial idea in this meeting that this would be about reinvesting the PEP. So it does take it to the next level. I guess if you're an investor yesterday, you had reasons to perhaps want to test the European Central Bank, to put it to the test. What is a pain level that they were willing to tolerate today? But I think today, you know, this meeting in this context, they actually provided more than a lot of people were expecting when going into the meeting. They now say very clearly, we have to create a new tool.
And that tool doesn't exist yet, and that's the problem for them at the moment. I have to say the bond market's pretty calm off the back of this. Euro dollar's rolled over a fair bit, almost unchanged on the session now to 104.28. If you're just tuning in, you missed the whole of this morning. We've seen this massive move in the Italian bond market. You've all witnessed that over the last couple of days. Clearly that got the attention of the ECB. They scheduled an unscheduled meeting, got together, sat around a table for 2 hours and had a discussion about what to do. They've reaffirmed something we've been talking about for weeks now, reinvesting PEP, but they go a step further, kinder. And it's the kinder that's going to shape this market this morning. Here's the kinder. The Governing Council decided to mandate the relevant Eurosystem committees together with the ECB services to accelerate the completion of the design of a new anti-fragmentation instrument for consideration by the Governing Council. There's a few steps here, Tom. You've got to come up with the instrument. Then it's got to be approved by the Governing Council. I don't know how long that's going to take. And in between, I have no idea what's going to happen with the bond market either. Your Italian 10-year this morning, 389.
Yeah, John, I want to make clear, Euro moments ago breaking through and breaching where we were at 1:18 a.m. New York time, and it's a weaker Euro. Basically, it's gone completely round trip on the strength of the hope of that meeting. So I do think that's really germane here with Euro 104.36.
Maria, any indication of how long this is going to take? Any indication at all?
Well, you know, things have changed so much over the past week that, you know, they could go quicker from now on. What I would say is that the last time there was a meeting like this, which was not on the agenda, that it was called in a panic, that it was called in a rush, it was back in 2020 during the pandemic. And that's when the PEP program came about. And that was implemented and put together quicker. You know, that is essentially the comparison that we have to this. The statement clearly doesn't say it. But to me, the fact that yesterday you have Isabel Schnabel coming up with there are no limits to what we can do, and now today say let's get to work and put it something or create something that is an effective tool, does show that behind the scenes in the Governing Council, at least they're more united than they were a week ago, where they weren't simply able to answer that question.
Maria, is a general statement, is it Brussels, or right now is it every nation for themselves?
No, I think, you know, I think a lot of things have changed. And when you compare this to the sovereign debt crisis, if you look at everything that's happened since the pandemic, it is clear that the European Union is becoming in many ways a fiscal monetary union and a political union. It's not just a simple trade bloc. But I think in the process, of course, there's questions about the fiscal that come with this. And I guess some of the members in the Governing Council will say, if we provide this tool, we also want to see guarantees that some of the countries, particularly in focus on this, are going to take things seriously, that things are going to change in terms of the fiscal story too.
Maria, do you have the sense that the ECB and the Governing Council was taken off guard on how quickly and violently the Italian 10-year yield moved?
I think they were. I think they were. If you look at that press conference yesterday, last week, Christine Lagarde was asked 4 times, how do you fight fragmentation? And she thought that would be enough to say we are ready to do it. And of course, we're very committed that our monetary policy feeds through to all of them. Again, the challenge for the central bank is that you deal with 19 different countries that are very different. So one policy fits all. It's harder than other central banks. But I think they were caught off guard. And this is why this meeting is happening today. And they've now decided to say this is not an abstract concept. We're going to put something on paper and create a tool that works.
A tool that works, Maria. Thank you. Let's think about that. The most effective tool in central banking of the last 15 years was a tool that was never used. It was the ultimate mechanism behind whatever it takes from President Draghi. And Tom, sometimes they are the most effective mechanisms of central bankers. It's a backstop. It's the threat to use something that the market believes in that you never have to deploy. Mario Draghi managed to tighten bond spreads in a monster way without buying a single bond through that program. So my issue with this time around is I'm not sure, and of course I don't know for sure, but I'm not sure at this point that you can come up with something that isn't deployed because of where inflation is and where rates are set to go, because of what's happening in the Treasury market and what's happening at the Fed. I'm not sure a backstop per se is sufficient to address what's happening in this market right now, but we'll see.
On radio, we've got the banner up right now. Here it is verbatim. ECB tells staff to prepare new anti-crisis tool for approval.
Yeah.
And the anti-crisis tool is simple. Who's going to take the loss? I can't say this enough, John. Most argument, this is Alan Meltzer 101. Somebody has to figure out who takes the loss. And Meltzer 101, a la Bernanke later on, is the government of the United States under question of the Fed takes the loss. Who takes the loss in Europe? That's a debate, right?
A great example of what's happening in monetary policy right now is the Bank of Japan, Lisa, and I know you want to go there. The BOJ is saying, here's our cap on 10-year yields, but just saying it in this market isn't enough anymore. You actually have to back it up by getting into the market and buying at that level.
And buying at record amounts, and even then it's not good enough because people are still betting against the Japanese central bank, saying that they're not going to be able to do this. But the reason why I'm referencing this with respect to the ECB is they have to be ready to deploy it. And then what do when it doesn't work anymore? When markets push against them so much based on fundamental issues, including inflation, that they're forced to capitulate. At what point is the ECB going to be not necessarily in the same situation, but an analogous one?
We've got to see what the vehicle is and the details of that vehicle. This is a plan to make a plan. And then we'll see if that plan to make a plan is ultimately approved further down the road and whether it addresses what's happening in this bond market. I can tell you that this bond market is turning around. We're down just 25 basis points on an Italian 10-year, threatening to get back to about 4%. I want to bring in Javier Blas of Bloomberg Opinion, columnist. Javier, at the epicenter of so much of this is what is happening with the energy market. We're seeing the average gas price in America through $5, and we're seeing central banks respond to what is happening with headline inflation. Javier, we've heard from several politicians that are trying to make the point that they would like to see more refining capacity. They'd like these companies to spend more money. At the same time, they're threatening with windfall taxes too. Javier, make sense of what's happening on the policy front, together with the politics of what we're witnessing right now in the global energy market.
I cannot make sense, John. It doesn't make any sense whatsoever. You cannot be threatening the industry with windfall taxes and at the same time telling the industry, oh, please, can you drill more and can you build a refinery, because now we have realized that we don't have a refinery. At the same time, you are telling the industry, we don't want you and we will prefer to do without you and move to green energy. The energy policy right now is a complete mess. We are paying the price of very unfocused energy policy over the last few years. The most important point today, I think, International Energy Agency took the first look into 2023, and the landscape that they are picturing is pretty ugly. Oil demand remains very strong despite a cooling economy, and supply is not able to match. So we are heading forward pretty high prices for the rest of the year, and potentially now into 2023.
Javier, very quickly here, we're really constrained on time. In the United States, there was a refinery of Marathon in Louisiana. And now, umpteen years later, 30 years later, there's a new greenfield opening in North Dakota with Meridian. I mean, that's how hard it is to build a refinery in America, isn't it?
It's very hard. No one wants to build a refinery. We have had expansions, but the biggest problem is over the last 2 years, we have lost a significant amount of refinery. Worldwide, we lost the most refining capacity in 30 years in 2021, and that is going to take time to address. And the only way to address really the mismatch that we have right now between supply and demand is to lower demand, and for that, you need a recession.
Javier, and that's the problem for the politicians and the central banks alike. Bloomberg's Javier Blas there on the energy market, and the energy market sparking a big problem for these policymakers right now. A bigger problem, I would say, for this ECB, Tom. What a challenge they've got to raise interest rates and cap what's happening in the bond market. Italian 10-year yields getting back to 3.93.
Yes.
Still down on the session in a big way, but way off the lows.
Well, you've got to watch those select group of bonds. I mean, I get that the Italians front and center because of size and maybe the prestige of Draghi, but John, this is a day to really look at bond price in Europe. And coming off the Fed meeting and our coverage this afternoon, frankly, tick by tick, each question within the press conference.
Lisa, I'd love a final word on what we're seeing taking place this morning.
It's pushing back. People aren't believing exactly what the ECB is saying. There was an expectation for something bigger than what was delivered. That is the message coming from both the moves that you're seeing in the Italian bond market as well as in the euro.
Lower the session on the Italian 10-year, 810, 376. Right now, about 15 minutes later, 393. That's the turnaround off the back of this ECB statement. Turnaround in the euro too. Euro dollar looks a little something like this. Positive 0.2%. It was much higher on that currency pair earlier. 104.36. Equities hanging in there, up 0.8% on this Fed decision day. More coverage still to come with Lara Rain of FS Investments. From New York City, heard on radio, seen on TV. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Just to give you an idea of the scale of this Federal Reserve meeting a little bit later this afternoon, we got retail sales out any second now, hardly being talked about anywhere this morning, including on this network. Let's get you some of that economic data, shall we? Let's get Mike McKee into the conversation. Morning, Mike.
Good morning, John. Retail sales yet to drop from the Census Bureau, but the Empire manufacturing number is out, and it rises to negative 1.2 from negative 11.6, a little bit better, but still not great news about manufacturing. Import prices have come in up by 0.6. The forecast was for a 1.1% rise. Now, ex-petroleum, they were down 0.1. So that's a little bit of good news on the inflation front. Here come retail sales. The advanced number down 0.3. The forecast was for up 0.1, and last month it was up 0.9. So the numbers are not particularly good on retail sales because remember, this is not adjusted for inflation. Ex-autos, they're up 0.5%. That's less than the 0.7 that was forecast. And retail control, which is the number that economists watch, goes into GDP, basically is flat, no change at all. It was up 0.5% in the month of April, which is revision by 0.5% lower from the original 1% reported. So basically what we're seeing here is a pullback in retail sales, people not buying as much. Gasoline stations on the month up 4%. And 43.2% for the year. And some others are pretty negative. Motor vehicles down 3.5%, furniture down 0.9%, electronics down 1.3%. And remember, that's inflation adjusted. So it does look like consumers began to pull back in the month of May.
Mike McKee, two-part question with a when and a how. When will this Federal Reserve be confronted with worse economic data than this? And how will they respond to it?
Well, that's the question. The 400 basis point question is how soon does the economy cool off and what are the signs going to be? A certain amount of it is maybe people pulling back because of inflation, but when do we see demand destruction? Is this a sign of it starting? We'll have to see. And then we'll find out this afternoon how fast they're going to move and whether they think they need to go, they won't say the word recession, but go restrictive.
Mike, you're going to be in that press conference. Is this retail sales, and particularly combined with the previous month revisions, is it enough to shift the 50 or 75 debate?
I doubt it, Tom. I think the Fed is focused on inflation right now rather than growth. And growth is strong enough. They've made that case over and over again that they can look past this. It's 1 month's data. We'll see if it continues. But that CPI report apparently did worry them quite a bit. And the University of Michigan numbers that suggest inflation expectations are rising is probably the overhang for all of it.
Mike, I realize we can't extrapolate out, but let's say we do, and this slowing in consumer spending persists for a number of months. Does this make the Fed's job easier or harder?
Well, it probably makes the Fed's job a little easier if it's accompanied by a drop in inflation. If demand destruction leads to lower prices, then the Fed does have the opportunity to back off a little bit. And maybe they go back to their plan of not necessarily pausing, but at least looking around and recalibrating how much they do each month when we get to the fall. Again, that puts a lot of the onus on Jay Powell's Jackson Hole appearance. But at this point, the Fed has got to fight inflation. And, when we're still over 8%, 8.6% on the CPI headline, that gets into people's heads. And they've got to do something about that.
And Mike McKee, can't wait for your coverage a little bit later. We'll catch up a little bit later this morning, too, ahead of that. Mike McKee, thank you. Something Mike McKee said there is so important. So headline inflation for the month of May disappoints, downside surprise. The previous revision, not great either. Tom, think about this, where inflation was and the fact that data is not inflation adjusted.
Yeah, it's not inflation adjusted is key, John. And I really wait to the revision. And I really can't convey this enough, folks. You look at the screen and the red and the green blinky of the famed Bloomberg screen. I mean, it lit up like a candle there, John, as people responded to
That's
those
weak
reports.
data, Tom. That is weak economic data.
DXY out over 105. We're watching Euro again off the festivities there. Weaker Euro 104.31 in the last 2 hours. A perfect time to speak to Laura Rahm. She's chief U.S. economist at FS Investments. Today's phrase, Laura, is crisis tool. Europe is in search of a crisis tool. What does the acclaimed Rahm inflation crisis tool look like?
I think that the crisis tool is clearly just trying to reclaim some credibility. And, we've talked about being behind the curve. These central banks just have to try to, assert control and just calm markets. I don't think it's even frustration with some of the air getting let out of financial conditions, but they want to try to calm markets that they are on top of managing inflation and managing policy. And I think that is what has been so difficult. And that's why we're seeing central banks around the globe really, that's what they struggle with.
Laura, is 75 basis points enough to get the job done?
I think that the Fed, I think it's a step in the right direction because for the Fed, it's just, I think giving that impression that they are on it, they're data dependent. I think that they have suffered from this idea that they're going to wait several meetings to see how things flush out. That is gone. So there's a proactivity there, but I do think that we are, as we get data that is already starting to roll over in several categories, the possibility that they are going to have to, really tighten into the face of weakening demand. And that, I think, is going to not help them at all.
Well, this is interesting because it's sort of the opposite of what Mike McKee and other people have been saying, which is it may help the Fed to see a cooling in the economic data because it indicates that perhaps not at this meeting or next meeting, but at the end of this year, they'll be looking at inflation trends that are more in their favor. What's your pushback to that narrative?
So, the issue is that Fed rate hikes just take a really long time to impact the economy. And I think when you think about demand destruction and where inflation is really coming from, it's shifted to now coming not from, auto prices, but really coming from rents, areas in the economy which are much more sticky. And for that reason, you really need to get housing to not only roll over, but house prices to moderate more significantly. These are changes that don't happen overnight, and they're changes that really come with, a wider implication for growth. So we've already got household sentiment under pressure. We've already seen households be impacted by inflation very negatively. The demand destruction is already here.
Well, what's the math here, Laura? If we get a 75 beat move, a 0.75 percentage point move, does the 30-year mortgage go up 0.75 percentage point?
It's actually, mortgage rates have gone up more than the long end has risen. So, I think we continue to see mortgage rates go higher. We've already seen, the housing market cool down. I think what we really are talking about is, the connection between the economy to the labor market, and the fact that there's a reason the Fed has trouble micromanaging demand. They are a broadsword. They're not a scalpel. So for that reason, I think there's just more. This is the tip of the iceberg when you look at demand cooling. And I think you could argue that demand right now isn't even really cooling because of Fed rate hikes. It's cooling because of inflation. So you look at the rate hikes they're making right now, that's going to impact the economy in several quarters. So they're really tightening aggressively into an economy that's already slowing.
So what will the confused rhetoric be of this central bank after the press conference today? We've covered confusion in ECB today like truly we've never seen. Are we going to be as confused?
I don't think so, because I don't think they're going to change their statement very much. I do think that in the press conference, Powell is going to continue to sound very optimistic about the Fed's ability to create a soft landing. But I think he wants to really strike a very serious tone on the inflation front. I think it'll be interesting to see how, if we get another month of an upside surprise of inflation, what this means for the July meeting. These are things that I think, just how sensitive to month data they're going to be. Because, the real, I think now piece that we're waiting for is to see how the employment market responds. That to me is really going to make or break how aggressive the Fed can be. And markets have, priced up the whole curve. They're now expecting the Fed to raise rates to 4% by the beginning of 2023.
Laura Raim, thank you, of FS Investments, looking ahead to the Federal Reserve. Not just today's decision, but the summary of economic projections as well, and an update to that dot plot. I'm going to catch up with two of the best. We're going to catch up with two of the best in the next hour. Lisa Shattuck of Morgan Stanley Wealth Management, Bob Michael from JP Morgan Asset Management. TK will do that in the next hour on Bloomberg TV.
I look at this, John, just absolutely extraordinary. I can't say enough, folks, how absolutely unique today is. I mean, there's no other way to put it, John.
Yeah, Lisa, this afternoon, a Federal Reserve and an unexpected central bank meeting this morning with the ECB.
Laura Raim highlighted it really well, hiking into weakness, and that is the theme across the board. When do we start talking about stagflation, and what does the bank do with that? I mean, the central banks, that is their nightmare, and that seems to be more of what we're looking at, but it's moving so quickly, and it's getting harder for economists to really get their hands around what to expect in any monthly data.
John, the thing I would say here is all we're left with is price, and price comes in many ways, including yield. I'll take yield as being one price indicator. But right now, I've got a modest and fragile pennant on euro at a 104.32. And the ramifications, if that breaks down to weaker euro, are incalculable.
Futures right now up 0.8% on the S&P, and the Nasdaq 100 up by 1 full percentage point. We'll guide you through that Fed decision a little bit later this afternoon, 1:30 Eastern Time. Tom Keene, Lisa Bramett and Jonathan Ferro with a Bloomberg Surveillance Fed special a little bit later from New York. Heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. U.S. Democrats appear to be considering new energy legislation. Sources say Oregon Senator Ron Wyden may propose a surtax of up to 42% on companies that record a profit margin better than 10%. Democrats and the White House are struggling to curb U.S. energy costs and broader inflation. Bloomberg's Front Row looked at the strategy and perspective of the asset manager for one of the world's largest privately owned management firms, John Haynes, who oversees almost $1.3 trillion, talked to Eric Schatzker about environmental, social, and corporate governance.
We don't think it's woke. We think it's part of, like, a very, very important part of studying the opportunity set and the risk set of 5,000 companies.
Is that to say there's alpha in ESG or alpha in sustainability?
Yeah, absolutely.
You believe that?
I believe that.
Hines also talked about the challenges of running a private partnership in an increasingly competitive industry. The UK has cancelled its first flight deporting asylum seekers to Rwanda. The European Court of Human Rights blocked the deportation, saying there's a risk of irreversible harm for the asylum seekers. The government says it is trying to discourage the work of human smugglers, but the policy has been condemned by UK rights groups and some lawmakers. Bill Gates has dismissed cryptocurrency and NFTs as shams based on what he calls the greater fall theory. Speaking at a climate conference, Gates said digital banking efforts supported by his philanthropic foundations are hundreds of times more efficient than crypto. Gates sparred with Elon Musk last year over whether Bitcoin was too risky for retail investors and the environmental harm of mining coins. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
People have just been calling this peak of inflation. We say you can't call a peak until the peak is over. People were too early to call the peak in inflation. We're going to start calling those type of peaks when we actually see that the market confirms that they are going down.
This conversation got a real buzz yesterday out in the zeitgeist. Catherine Kaminsky, she is with Alpha Simplex. And for those not in the know, this had to do with turtle trading and trend-based trading. It was a clinic on trying to find peaks and troughs in a market. We're going to do that right now. We're going to begin with a clinic with a chart. Joining us, Kriti Gupta on liquidity in bonds.
I'm stepping on Lisa's toes here a little bit, but I'm going to try to do this concept justice. I like to keep her on her toes. This is a really important concept because as we talk about higher volatility, you got to talk about the liquidity as well. And that brings me right to my chart of the day. Looking at a Bloomberg index that measures the trader's ability to execute deals without affecting the price. For our radio audience, the line just goes higher and higher and higher over the last few months, now going back to levels last seen in March of 2020. Remember, the market was not functioning then. And it's not just something you're seeing in the chart. It's something a lot of these banks are actively talking about. Morgan Stanley saying that the liquidity in some shorter-term U.S. Treasuries are flashing warning signals. And unlike in 2020, the market does not have the backstop of central banks, that according to an internal note to clients. So once again, this is very much a part of what people are talking about. And remember, today is day one of QT, the idea that $15 billion of maturing treasuries, well, they're not getting reinvested. What happens when that scale increases more and more time?
And wrapped around an ECB and Fed joint meeting, it appears to be today. Kriti Gupta, thank you so much. And Lisa, this really comes to the heart of the matter, which is the trust within short-term paper.
And I will just say for the record, Kriti, you are never stepping on my toes, and I'm glad you're highlighting important points. Because right now, liquidity is one of the main concerns that a lot of bond traders have. Among them, Ira Jersey, chief U.S. interest rate strategist at Bloomberg Intelligence, who's been covering the bond market and watching it for decades. Ira, how poor is liquidity in the biggest, most liquid market that is thought of as completely safe and is trading like Bitcoin?
Well, firstly, it's not. I would argue that it's not trading like Bitcoin. But in terms of liquidity, it's certainly the worst liquidity we've had since the global financial crisis. And we all knew that something like this was likely to happen, primarily because banks don't have the ability to, and dealers don't have the ability to intermediate the market the way that they used to, because the size of the market has grown exponentially over the past couple of years, and at the same time, the dealer balance sheets haven't been able to expand, so financing trades and the way the plumbing all works has just not grown, and has actually gotten worse because of some of the regulations that have been placed into effect to try and make banks safe and sound. You're now making their ability to intermediate markets less possible.
Ira, on a high level kind of conceptual basis, can you give us a sense of what happens when the system gets gummed up, when some of the trading stops in the same way that people have become accustomed to?
Well, what it really means is that it used to be that a bank or even a hedge fund was able to buy a bond and then finance that via the repurchase agreement market. And the repurchase agreement market is what SOFR, the LIBOR replacement, is made up of. And it's a huge market, right? It's $1 trillion a day, more or less, trades in that market on an overnight basis. But the problem is that $1 trillion is the same size as it's been basically for the last 20 years. And meanwhile, the market's gone from, a couple of $1 trillion. The Treasury market's gone from a couple of $1 trillion upwards of $20 trillion, right? So that's grown 10 times. So what happens is when a dealer buys a bond, they have to be able to finance it somehow. And if they can't finance it, then bid offers widen, and that's one of the things you're seeing in the liquidity index. Or they have to go out and find another person on the buy side to take it from them, and that means that they have to move the price probably. So that's I think one of the big reasons you're seeing the size moves that you're getting. I'm not surprised by the level. I'm just surprised by how quickly we're getting to some of these levels, and that's where the liquidity situation is showing itself.
Ira, a most unusual day, this emergency European Central Bank meeting, and clearly the observation is Europe is different. Europe has bonds, many more bonds on a relative basis. How do you expect bond prices to react and respond in Europe as they go in search of a new crisis tool?
Yeah, so it's really, will we get the periphery spreads down? Like, I even think in Europe, they don't mind yields in general going up, but it's more, again, the liquidity magnitude and the spread for some of the sovereign countries over there that's going to take precedence, and the reason why the ECB, felt it necessary to have this emergency meeting today. But it's also not a major surprise, just given the liquidity situation there as well. And you see the fragility of something like the Eurozone system, because even though you have a single currency, you still don't have a single fiscal structure, right? So one of the advantages that the United States has and Japan and some of the other large sovereign bond markets is you do have a very homogenous government fiscal system in general. And I think it's going to be more and more difficult, especially in times of stress when markets are falling, for those peripheral countries not to have some kind of integration with the core.
What we're really talking about here, Ira, and again, folks, into our coverage this afternoon, is people arguing about who's going to take the loss. Who takes the loss when bond prices go down?
Yeah. Well, I mean, everyone does, and the taxpayer ultimately does in the United States, because you have to pay higher yields to finance deficits and to refinance some of the maturities that are coming up, and that's especially true now because today is QT day, so today is the first day that we have maturities of Treasury securities that are not going to be reinvested. So you just have more people, more investors that need to try to buy that paper going forward. Now those auctions were last week. So we kind of know the price that had to be paid in order to refinance those. But nonetheless, you're going to see more and more liquidity issues as time goes on, and everyone pays the price ultimately, right? The economy in general pays the price, but we're already paying the price, and I think that's the point, right? Look, when you look at what the market's pricing right now for June CPI and for July CPI, we're talking about 9% CPI prints the next 2 months. So, Tom, that's something that central banks and the Fed in particular, I think at this point really want to try to get in front of, because they're already behind.
Ira Jersey, thank you so much. Greatly appreciate it. And Lisa, that goes to the resiliency of oil. Brent crude to the 120 handle moments ago, printing 121. Is it 124? No, but certainly the idea of a pullback in hydrocarbons just simply hasn't happened.
It hasn't happened. I just want to note, heading about 35 minutes to the opening bell in New York City, that we are seeing a further lift, a real build on some of the strength that we saw about rebound or trying to have a bit of a bounce ahead of the open. And it really comes the extra leg on that weaker than expected spending data, and as well as Empire Manufacturing for the month of June. Tom, this is significant. People are viewing this, at least in markets, as possibly a ray of hope for the Fed, that there's already a cooling in the economy that will allow them to not move as fast, as far. Whether that's borne out and what they say about that today will be interesting.
Give me an intraday chart on the way out, guys. We got to do this differently. Euro, right now, there's only one word: plunging. Dramatically weaker euro as we go into the next hour. What an eventful, historic day. Our Fed coverage this afternoon.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What a day coming up from New York City this morning. Good morning, good morning. Equities bouncing back. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. One number on everyone's mind.
It's absolutely necessary to move to 75.
We do see 75 basis points.
Yes, they're probably going to go 75 basis points. They could do more than 75.
75, 50. For me, it's a flip of a coin now.
Our call is for a 50 basis point rate hike.
If we get less, the market might actually react to the downside.
Three options for rate hikes: 50, 75, or 100.
The Fed has to basically choose between high inflation or kind of recession.
Inflation is really the Achilles heel of risk markets.
Obviously, the market reaction has been aggressive.
At this stage now, given the market reaction,
the damage has been done.
You have to think about further out. What's the guidance? What does the dot plot look like?
The Fed is in a really complicated position.
Joining us now to discuss all-star lineup, Morgan Stanley's Lisa Shallett, JP Morgan's Bob Michael. Lisa, first to you. What are you looking for later this afternoon?
We're in the camp that says it's going to be somewhere between 50 and 75. I mean, look, Powell really has backed himself into a corner by saying 75 was off the table. And, so the minute he does 75, he's going to be questioned about, what it is that the Fed thinks they know, when do they know it, and how data dependent are they? I think some of, the commentary leading into this, segment said it all, which is, the market has priced 75, if not 75 today, certainly a couple of 75s over the summer. So this is a market where a lot of the hawkishness is priced in, and my expectation is we actually got a relief rally here as Powell comes out very, very hawkish.
Bob Michael, do you share that view?
John, I'm in London, so I'm going pseudo-Shakespearean on you. Hell hath no fury like a Federal Reserve scorned. They deliberately put out their 75 basis points. They've now had about 3 days to assess market reaction. Things have settled down. The door is open for 275 basis point rate hikes over the next 2 meetings. They should take them and start today.
And they're set to, according to Goldman, according to Mike Feroli and the investment bank at JP Morgan, according to Jefferies, SocGen, Wells, Deutsche Bank. I can go on and on and on, the amount of banks that are calling for the same thing. Bob, here's something I've noticed. I would love your input on it. Let's take Goldman as an example. They wrote the following. We've revised our forecast to include 75 basis point hikes in June, again in July, that's what you want to see. This would quickly reset the level of the funds rate at 225 to 250. The FOMC's median estimate of the neutral rate, we then expect a 50 basis point hike in September and 25 basis points in November, December for an unchanged terminal rate. Now, this is what gets my attention, Bob. I'm hearing 75. I'm hearing 75 again. But all I see on Wall Street at the moment, Bob, from the economists, they changed the timeline, but not the destination. What do you make of the latter point?
Let's listen to the Fed and look at the infamous dot plot. Right now, there are 275 basis points of rate hikes priced in from now to year end. So that puts the Fed funds rate at that range of 3.5 to 3.75%. That looks reasonable to me. It feels as though the Fed believes that its best shot at a soft landing is to front end load the rate hikes, much as what happened in 1994. That's their plan. In a few hours, we'll see whether they agree with the market pricing. As I said, it's a gift to them. Take that market pricing and validate somewhere between 3.5 to 4% over year end.
Elisa, I'd love your view on this. Has the destination of this Fed changed for you? We understand the pace of the journey. They want to get there quicker. They want to front load. Bob's talked about that. Has the end point changed? When the Federal Reserve and the fund rates peaked, has that end point changed for you in the last couple of weeks?
I do think that it has. I mean, I think that there has to be an acknowledgement, and I think that increasingly there has been, whether we go all the way back to Janet Yellen's admission that, from the Treasury perspective, she made a mistake, all the way up to the Fed capitulating and saying, yeah, this idea that 75 was off the table was silly. So I do think that inflation is likely to be higher for longer. There are a lot of structural cross currents at play here, and that means that your terminal rate does need to move up, even if you're trying to get there faster.
Futures right now up 0.9% on the S&P, on the Nasdaq 100 up by 1.2%. You're familiar with the moves of the previous 5 days. 5 days lower, over those 5 days down by more than 10%. Brutal. A little bit later this afternoon, you get a Fed decision at 2 p.m. Eastern Time. 30 minutes after that, you get a news conference with Chairman Powell. In that news conference, Mike McKee. Morning, Mike.
Morning, John. I'm going to pick up where Bob Michael left off and say that comes now the summer of the Fed's discontent, if we're going to do a little Shakespeare, because they don't like the inflation numbers that they're seeing, especially the idea that inflation expectations are becoming embedded, which leads to this change from the 50 to 75 basis points move this meeting. And as you can see, we've priced in another 75 for July. So the markets are giving the Fed permission to do it. Do they go ahead? Well, the questions we're going to be asking today, and the markets are going to be asking today, what qualifies as a surprise, and do we get one? Would 100 basis points be a surprise? Would 50 basis points be a surprise? Lisa said if we got 50, the markets would be disappointed. What's the terminal rate now? You brought that up, and how long does it take to get here? It does seem that their strategy is now to front load. And what's their unemployment rate forecast? That'll give us an idea of whether they think they can get a soft landing in place. It's going to be a read between the lines number, because they aren't going to say a recession is out there. But do they think that they can really keep the unemployment rate below the 0.5% that brings the Somme rule and recession into play? We had retail sales earlier today. You could see how much gasoline is eating up and groceries eating up in terms of retail sales, but they did fall a little bit despite the rise in energy prices. So is the Fed already tightening into a slowing economy? That's another question they have to judge today.
And look at these companies. Compass cutting 10% of the workforce. We had a report yesterday, Warner Brothers reporting 30% of ad sales. That sales force could get cut. That was a report, according to, I think, the information on Warner Brothers. Mike, stand by, because Bob Michael often likes to offer you advice on what you should ask in this news conference. Mike McKee, I'm going to get that view right now. Bob Michael, can you tell Mike what you think he should be asking in that news conference a little bit later this afternoon?
Yeah, he should be asking if they're satisfied where financial condition indicators have gone. They've tightened a lot. They've done a lot of work for the Fed. There is a view that that's one of the things the Fed wanted to enforce by going to 75 basis point rate hikes, to have the markets start doing a lot of the work for them while they're on this journey to something that's more reasonable.
And Mike McKee, I'd love your response to that.
Well, I think Bob makes a very good point, and it is something we can ask Jay Powell. I've heard this from some analysts that the Fed is not looking so much at the rates, even though they have to put out rates in the dot plot, et cetera, as they are at financial conditions. And financial conditions have tightened a lot, and that may be already starting to have an effect. We're seeing it in housing, we're seeing it in autos, and maybe we're seeing it, the very beginnings of it, in retail sales.
Mike, thank you. Mike McKee, we'll catch up a little bit later and ahead of that news conference later too. Mike McKee there of Bloomberg, down in Washington, D.C. ahead of that Fed meeting. This is what Bill Ackman had to say out on Twitter yesterday. Said the following: the Federal Reserve has allowed inflation to get out of control. Equity and credit markets have therefore lost confidence in the Fed. Market confidence can be restored if the Fed takes aggressive action. Lisa, I want to come to you on that because you made that point about 8 minutes ago. Can you explain the difference to me between hawkish enough, that's received as positive by this equity market, and too hawkish?
Well, at this juncture, I'm not sure that Powell has to worry about being too hawkish. I think, as we've noted, the action in the bond markets and treasury markets over the last week have given you a lot of room and given you, quote unquote, given the Fed permission. I think, to the point that's been made, if the Fed does not take the opening and do 75, talk about their willingness to continue to be very aggressive, very much, channeling Volcker, I think that this credibility gap, it becomes even bigger. And I do think that we suffer to the downside, unfortunately.
But what's your take on the same topic? We've heard a lot about what people expect. I've heard little about how they think this market will respond to it.
It comes down to one thing. When the Fed is raising rates while unemployment is going up, then that's going to tell us how hawkish are they intending to be. Where is inflation? And I'm not talking about 1 or 2 months of unemployment going up. I'm talking about if you get 3 or 4 months of rising unemployment, but inflation is too high. Let's say in a range of core inflation measures, it's above 4%. Do they continue to hike at a very rapid rate? I think that's when you have the debate about being too hawkish. Right now, today feels to me like it's another classic version of sell the rumor, buy the news kind of stuff. And I think that's what we're going to see.
We'll keep building on that, Bob. I want to know what you've been buying as well. Bob Michael, Lisa Shallett, sticking with us. Equities up 0.9%, breaking down the movers going into the open. Here's Abby.
Good morning, John. Yes, we do have a bit of a firmer tone to markets this morning ahead of that Fed meeting. And a piece of it, of course, has to do with big tech and the discretionary sector. Both Tesla and Amazon in the consumer discretionary sector, which interestingly is popping higher overall after those soft retail numbers. Relative to Tesla, there's also some interesting news out, which is that Tesla has reported the most automated system-involved crashes. This according to the U.S. National Highway Traffic Safety Administration. 273 of 367 such crashes were reported by 12 auto companies between July of last year and May 15th of this year. Too limited to draw any safety conclusions, though. As for this morning's rally, it's pretty broad, going beyond tech and consumer discretionary into the banks. Bank of America up 1.2%, and the travel trade finally getting a lift over the last 5 days, John, into today. Extraordinary declines, more than 25% for some of these airlines. But today, Delta Airlines up 1.5%.
Abby, thank you. Coming up, the ECB holding an emergency meeting.
They really have a fine line to walk. The ECB, rightly in my judgment, has now pulled forward tightening, but they have this issue in terms of the integrity of the euro, peripheral spreads.
The ECB has a plan to come up with a plan. That conversation next.
courts has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
They really have a fine line to walk. Different economies, different inflation dynamics. The ECB, rightly in my judgment, has now pulled forward tightening, ending quantitative easing, being pretty clear that they're on a path to tightening. But they have this issue in terms of the integrity of the euro, peripheral spreads.
What a difficult one. A tough needle to thread, if you will. This ECB with a really strange meeting this morning, an emergency meeting which concludes with a plan to come up with a plan. The Council decided to accelerate the completion of the new design of a new anti-fragmentation instrument for consideration by the Governing Council. Yields are down aggressively in Italy. We can get to Maria Tadeo for a little bit more. Hey, Maria.
Yeah, Jonathan, and can I just say, you think it's going to be an easy day at work and you find yourself in a full-blown emergency meeting. But Jonathan, a number of things here. When you look at that statement, of course, they commit to this reinvestment of the PEP. We knew that is what was always going to be the case. But I think the real takeaway, of course, is that line to say we will instruct the completion of this new tool. Now, a number of things here. Jonathan, one of my best contacts told me, and I think this really encapsulates the situation very well, the European Central Bank today is saying what they should have said a week ago. When you look at the statement, overall, it doesn't give you any reasons to buy, but it doesn't give you a reason to sell. And if you're the Italian central banker today, that's probably good enough. Now, the other thing that to me is very telling is the timing of this meeting. You know, this isn't happening in the move of around 250, 230, 70, approaching 300 basis points in BTPs. When Mario Draghi said whatever it takes, it was a full-blown crisis. So this does give you an idea of where the pain threshold would be for the ECB. And fundamentally, and this to me is the big question going forward, is when this tool finally gets agreed, and we don't know the timing of it, we don't know the details of it either. However, what is the quid pro quo? Because this is how Europe works. They agree to something, they agree to this tool, but what will be the condition or the conditionality for this tool to be applied? And that to me will be the real question going forward.
Maria, I'll give you something else to worry about. Abigail Doolittle, here's a headline from Gazprom.
There is certainly a headline, and Gazprom is halting one more compressor, squeezing flows to Europe. Gazprom, of course, is a Russian-majority, state-owned multinational energy corporation, and their gas exports, John, have tumbled to the lowest since at least 2014. So this, of course, means that the supply of natural gas to Europe under siege, and not surprisingly, the price spiking on this. European natural gas on the session spiking 12.39%, and that is on top of the 28% gain yesterday and on top of the 5% gain below that. So my math, if I do it very quickly, up more than 40% in 3 days, not helping out this inflation situation for Europeans at all, John. Again, the headline, Gazprom is halting one more compressor, squeezing flows to Europe.
Europe stuck between a rock and a hard place. Abby, thank you to Maria Tadeo as well. Bob Michael, Italian 10-year 377, down 40 basis points or so on the day. Do you like that there? Does that make sense to you?
I do, and two things come to mind. The first are central banks think the repricing has gone far enough. They're starting to respond to what they see as stresses in the system. And certainly for the ECB, it's looking at Italian debt. We expect overnight to hear something from the Bank of Japan on their yield curve control targets because the 7-year futures has gotten out of whack with the 10-year yield control. So watch for that. The second thing that jumped out at us is we think the ECB missed an opportunity here. You have an emergency meeting. You're miles behind where you need to be with rates for where inflation is. Why not also raise rates 50 basis points? So announce two things. One, you're going to support Italian debt through whatever your new anti-fragmentation policy is. And then secondly, you're raising rates 50 basis points because you're behind the curve, and start to front-end load some of that the way the Fed has done it. It's an opportunity missed.
Can you achieve both, Bob? You're an investor in this market.
Oh, without
how would you receive that?
I would have received that far better. I would have given a sigh of relief and said, okay, they get it. Last week's news was a mix of not enough and probably a little too much, and there's a chance to go back and fix it. You fixed one, not the other.
Lisa Shallett, equities in the States, that's a tough buy right now and has been all year. Can you talk to me about equities abroad and Europe specifically?
Yeah, I mean, look, we're continuing to try to be constructive here, but we have become more concerned over the last bunch of weeks. As Bob alluded to, that the ECB may be, a little too late. What is it that they say? Never let a good crisis go to waste. And, I think that, especially on today's headlines, not only did you have the emergency meeting, but now you've got Gazprom. The incentives here for Europe to unify behind an anti-fragmentation strategy and really articulate it for the periphery markets, as well as, signal to the EU that now is the time to really articulate a path around fiscal, support. If I were Lagarde, I would be a lot louder and a lot more specific.
There's some real stress emerging here, and Bob, you've touched on it. And then I look at high yield spreads at about 480-ish, and I'm trying to make sense of it. Bob, a number of months ago, we've been talking over the last few months about opportunities in the market. You liked credit, where it was trading. Can you run me through how you're thinking about it now, given the changes we've seen, and whether spreads this wide are really that wide at all?
No, no, they're not. They've held in incredibly well, given what's happened to pretty much all the other markets. If you go back to the March FOMC meeting, high yield spreads were about 425. If you just go back a month, they were about 500, so they're actually still tighter. If you look at investment grade credit, spreads are about 115 basis points. You go back to March, they were 155 basis points. So there's a couple of things going on. One, everyone's comfortable with the credit markets. If you look at high yield, 6% defaulted away in 2020. The remaining 94% looks pretty good quality. And corporate America has done a very good job of lining up funding over the last couple of years. It looks in good shape. Defaults are really low. So with the backup in yields, although credit spreads have held in, you're now able to buy investment grade credit at 5% and high yield at 8.5%. The other thing we're seeing going on is the kind of up in quality trade. It seems odd to talk about high yield up in quality, but if you're in equity, you go up the capital structure into high yield, and we're seeing some of that occur.
Lisa, let's talk about it. You get the final word. If you're a buyer here, where are you a buyer?
So we're chasing alpha here. The beta or the market index trade, we think still is vulnerable, and a lot of that has to do with valuations. And as we've talked about many times, the market cap skews and the concentration. But we think that there's stocks to be bought that have fully discounted not only the Fed path, but an outright economic recession that we still don't see fully on the horizon over the next 12 months. So where is that? That's in some of the industrials, some of the financial names, some of the home builders now, biotech. Those are all trading at recessionary type valuations. And we think that there's some really good buys there, and we're stock picking right now.
Lisa Shallett at Morgan Stanley, Bob Michael,
Lisa,
JP Morgan.
Lisa,
Bob, you've got about 10 seconds, Bob. Squeeze it in.
Okay, Lisa, the top of the capital structure is open for you. Leave the bottom, come up here and join us.
Bob Michael, are you trying to drum up business on this show?
We're doing that too. So just so you know, we've been buying credit as well.
Lisa, Bob's just trying to make markets. That's what he uses my programs for. Don't worry about it. Lisa Shallett, Bob Michael. Bob, you're naughty. Coming up, the morning calls, and later, Nuveen's Brian Nick seeing opportunities within growth stocks following a monster sell-off over the last 5 days. Your opening bell just around the corner from New York. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Equities trying to bounce back from 5 days of losses with positive 1%. Here are your morning calls. Wells Fargo upgrading Spotify to equal weight, seeing a legitimate path to profitability. Atlantic Equities downgrading Robinhood to underweight, expecting recent volatility to weigh on trading volumes. And finally, Morgan Stanley cutting its Apple price target to 185, noting that consumers are turning more cautious on spending. The stock is up by about 1% in the pre-market. Coming up, Nuveen's Brian Nick seeing opportunities in stocks even in a mild recession. That conversation next, your opening bout just around the corner.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Easy to get wrapped up in the drama of the moment and forget where you've been. 5 days, down more than 10% on the S&P 500. It's a monster move. We're bouncing back a bit, up by 1% on S&P 500 futures, on the Nasdaq 100, up by 1.28, on the Russell, up by a little more than 1%. There's your opening bow. Will it stick? Switch on the board and get to the bond market. Speaking of moves, your two-year yield this time last year was in at around 20 basis points, right the way through 3% over the last week, up 70 basis points over the last 5 days coming into today's session. The 10-year absolutely flying recently too. It comes in 10 basis points, taking the smallest of bites out of the move we've seen so far. And in the FX channel, I have to say, out of everything happening right now, this is fascinating. Euro dollar 104, cable sterling against the US dollar in at around 120, and seemingly nobody wants a weaker currency this time around. Not everyone can have a stronger one, and right now it's all about dollar strength over the last year so far. That's the cross-asset price action. Let's get you some single names, some movers. Here's Abby.
Well, we certainly do have a nice relief rally here on the open, John, with yields in sharply ahead of the Fed. It seems to be fueling some risk appetite on the part of investors. Tech in particular is higher. Apple up about 1%, of course, the heavyweight to all of the indexes. And the S&P 500 right now on pace for its best day in almost 2 weeks. So very impressive. You also have banks higher, up 1.2%. Interestingly, yields are down, but the yield curve is steepening, so that's helping out banks. Now, of course, we had that weak discretionary number, retail sales number, excuse me, for the month of May, coming in down 0.3% versus a survey of up 0.1%. And last month, or April, I should say, up 0.9%. So inflation clearly finally hitting consumers, one of the worst areas, as you know. Auto dealers, however, the automaker Ford up a little bit. Earlier, it had been up more than 1%, so some wobbly action there. And of course, one of the strong areas, sporting goods. You see Nike, which would supply to some of those sporting good stores, up 1.7%. Overall, a very strong start here for stocks, John.
Abby, thank you for now. 1 minute and 40 seconds into this. We are positive by 0.9% on the S&P. Information technology near the top of the pile, up by a little more than 1% on the West Coast. Ed Ludlow joins us now for more. Morning, Ed.
Yeah, good morning, John. Nice to see you. Happy Fed day. We're up 1.2% on the Nasdaq 100, around 1% on the Philadelphia Semiconductor Index. Two-day rally as it stands in that technology sector as yields, as you pointed out, kind of taking a time out in the moment. But you look at that move on the 10-year yield, and that's the story and the pain that we felt in the technology sector. We started the year talking about a conversation where higher rates discount the present value of future profits for tech. You read across the Bloomberg, and we await that move from the Federal Reserve later this afternoon. The conversation shifting to soft landing and recession risk. You look at the bull run in technology stocks and then what's happened since year to date, and the market cap shed on those big names. The concern is really now around principally recession fears and what it's going to take. I like history, John. You look back to the 90s when I was a young man, Cisco took a really long time to bounce back from its bull run high in that period to where it is today. You know, it's not going to happen overnight, whichever direction we go. I like this G chart on the Bloomberg terminal as well, because very quickly it shows the weight that this sector's had on the market. The white line is a basket of, well, basically, if you strip out tech, S&P 500 mega caps fare well. You put tech back in and they underperform, John. So I think we're really waiting to see if the move by the Fed could give us some relief on yields, because we'll have some certainty in the direction of travel, and perhaps that will give us some painless weeks in the sector.
Just quickly, of the companies you cover at the moment, are you hearing anything about job cuts? Because we're seeing it here, there, and everywhere at the moment.
Here, there, and everywhere. I think what's really interesting is that CEOs offer 2 points of view. They are making changes. They are being at least conservative with hiring, freezing, making cuts in non-crucial roles. But at the same time, they keep telling us that demand is robust. We had Cisco CEO Chuck Robbins on the show with Emily Chang last night. Same message. The demand is there from SMEs right through to large customers. So 2 very competing messages.
I'm convinced there is no one more awake than Ed Ludlow in San Francisco right now. Kind. Ed, thank you. Good to catch up, buddy. As always, about 4 minutes into this, one sector's negative. It's energy. It's down by about 0.4%. Taylor Riggs has more. Hey, Taylor.
John, and certainly a run-up up until today. If you want to take a longer view year to date, it certainly has been oil that's gone up to in the last few days about $122 a barrel. But of course, coming off of that with some of the macro headwinds about a Federal Reserve tackling inflation. And so you see that here, looking at one of the largest 2-day slides that we've had in about 3 weeks, and perhaps maybe some more worried about the economics and some of the reopening of the economy. There's also some more sort of fundamental news within this industry as well. Of course, in the last few weeks, we've heard a lot of comments from this administration saying that Exxon and some of these oil companies make more money than God, and they need to pay more taxes, and they need to start opening up and helping the American consumer. And so you're sort of getting some of those headline numbers as well, pressuring the industry maybe just a little bit on an intermediate basis. I think that what is interesting, and we have a chart here showing sort of all the profits. I want to be clear that in 2010 to 2014, on our FA function, for example, with Exxon, the company actually made a lot more money on an annual basis. Prices were about the same. So certainly making more money, but I think coming out of 2020 when they were losing money, and then going back historically, maybe 10 or so years ago, numbers also look different.
Are you just a little bit confused by the approach of this administration when it comes to energy companies?
Hugely. I don't understand how you tell them that they're horrible people and then don't expect them to drill.
It just doesn't quite stack up at all. We'll catch up with Anne-Marie a little bit later. Taylor, I'll save you from the politics. Thank you. Just on energy, Bank of America had a fund manager survey out yesterday. I'm sure many of you saw it. All-time low in global growth optimism. Profit outlook the worst since 2008. Then one of the most crowded trades, in fact, the most crowded trade of investors was long energy. Long oil, long energy equities. Now, something surely has to give there. If you believe there's a recession coming down the road, where are energy equities in that world? I would love to know. Brian Nick's going to weigh in on that in just a moment. But there's a ton of pessimism, we know that, and Bernstein's pushing back. Here's a quote from them. The probability of an outright recession has likely increased. It seems reasonable to expect that earnings need to be cut. However, it's possible the market has overshot this. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, speaking of something's going to have to give, there is a mismatch here between the performance of the equity market and earnings forecast. Because usually when you see equity markets rolling over, dropping to the extent they have with the S&P 500 down more than 20%, you would expect that profit forecasts have also rolled over. And yet that hasn't really happened to the same dramatic extent. Yes, the Citi Earnings Revision Index for the U.S. is in negative territory, but the pace of the decline has slowed in the last 4 weeks, while the pace of the decline in the equity market has sped up. And Bernstein points out that's only actually happened twice in the past 3 decades. So either analysts are too optimistic or investors are too pessimistic about the risk to earnings. And that's really the question here. One thing we know for sure is that post-COVID earnings boom, it is now over. After 11.3% growth in the first quarter, companies are only expected to see profits up 5.5% in the current period. And then the second half looks a little bit better, back up to around an 11 handle. But so much hinges on inflation pressure and the margin story. The ability of companies to exercise pricing power, pass on the higher input costs they are facing on freight, on labor, on raw materials to the end consumer. and be able to retain margin. That's something we've seen get a lot more difficult for companies like Target and Walmart. And as a whole, S&P 500 margins already fell to 13.1% last quarter. That's down from the 13.9% peak during COVID. And according to Bloomberg Intelligence, analysts forecast that 54% of S&P 500 members will have lower operating margins in the second quarter than they did a year ago, John.
Kelly, thank you. Thank you very much. Just on Kelly's point, it's kind of odd, isn't it? You hear a lot of people talking about recession risk, but hardly anyone cutting their outlook for earnings. Where is that information? Where's that guidance? In fact, we heard from Microsoft in the last couple of weeks, almost pre-warning, pre-announcing on earnings based on what's happening with foreign exchange. Dollar index yesterday was 105. Where's the rest of them? Where are the rest of them warning about the same thing? Deutsche Bank's Binky Charter put out a note yesterday afternoon. In fact, we caught up with him a little bit earlier too. He said the focus is increasingly on whether forward estimates are too high and will be the next shoe to drop. They remain vulnerable to significant downgrades, even if we don't fall into a recession imminently, and of course, much more so if we do. Brian Nick-Anuvi joins us right now. Brian, I'll start with that one. Where are the earnings downgrades based on the recession risk that everyone's obsessed with over the last few months?
I think they only come if and when we start to see actual real data from consumers that shows them pulling back.
Hello traders, how are you doing today? Are you ready to trade Bitcoin? I'm placing an order to buy Bitcoin at 21,187. Please place your order, 21,187. If you want to trade Bitcoin, if you want to copy my trade and stay with me, let me place 21,187. Order placed. Stay with me and we will close this trade together. All I want to say that compared to other forex pairs, we trade Bitcoins based not on pips, based on percentage, because the Bitcoin was very volatile for the last couple of years. So 1% gives us 1,000 pounds, 0.5%, 500 pounds, and so on. So if as soon as order will be filled, stay with me. I'll let you know when we're going to place stop loss and so on. If you want to get the strategy, you need to go to company.co.uk and you can get the strategy and trade other securities or other cryptocurrency. You can trade anything you like. I also will provide webinar if you want to. The webinar will be tomorrow, so place is still available. It's summertime, lots of people on holiday. So if you want to sign up for the webinar, please do so from company.co.uk. Okay, guys, I'll speak to you later.
Brian, I'm not convinced one way or the other how they respond to it. Are you?
No, I'm not. And I think the last couple of days have really given me a lot more doubts about exactly what the Fed intends to do. So ostensibly, we had an upside inflation surprise. I think a week ago, nobody on the FOMC thought they were going to be raising 75 bips today. And now it looks like it's all but a done deal based on an upside surprise to headline inflation, which should not be the Fed's main concern. So if you get weakness in the employment data over the summer, the housing market data, which I think we will see more weakness, more softening in that data, but energy prices stay high, does that mean the Fed's just going to keep hiking? And I think one thing that I think the Fed is probably going to accomplish today by hiking 75 bips is probably a little bit more inflation fighting credibility, but a little less credibility on exactly what its guidance means for the future and how much stock we can take in what it says it's planning on doing. So ideally, yes, you'd like to see the Fed get expeditiously back to neutral. I think we'll see that neutral rate creep up today. It's probably too low, somewhere around that 2.5%. But assuming we get there and maybe a few hikes past there, my hope and expectation is that by the fall, it's going to be obvious that the Fed doesn't need to do a whole lot more to get those leading indicators for inflation under better control.
Brian, we're going to keep talking about this. We need to talk about energy as well. The S&P right now up by a little more than 1% on the S&P 500. Energy on the S&P down by about 0.6%. Brian Nick will be sticking with us. Coming up, Washington ramping up efforts to tame soaring gas prices.
I'm doing everything in my power to blunt Putin's gas price hike. Just since he invaded Ukraine, it's gone up $1.74 a gallon because of nothing else but that.
We'll have a conversation about that next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
doing everything in my power to blunt Putin's gas price hike. Just since he invaded Ukraine, it's gone up $1.74 a gallon. Because of nothing else but that. I have a plan to bring down the cost of gas and food. We're the largest release of oil from the global fund in history.
Pretty frustrated President Biden there. So frustrated he's written a letter to oil companies. Part of it reads as following. At a time of war, refinery profit margins well above normal being passed directly into American families are not acceptable. AMH, I just want you to run through this letter and let's talk about the contradictions of this administration when it comes to this particular topic.
Right, so I think the contradiction you could see at the end of the letter where the president says the administration prepared to take any, quote, responsible and appropriate steps that would help these countries increase output. So they are going to Houston. They are asking these major American oil companies to help with the refining capacity, right? He talked about the SPR. There's a lot of oil in the market, but there's another issue at play, which is the fact that you have to turn that oil into gasoline, into jet fuel, into diesel, things everyday Americans need and are using right now. So the fact of the matter is that the administration is really trying to get these companies on board, but they feel that this administration, coming in to the beginning of this administration, that the tone has been quite hostile towards them. This administration has really embraced renewables, embraced ESG, and wants to move the country off of fossil fuels. But now they're in a situation where they need them because gasoline is at $5 a barrel and there's really a gallon, and there's really nothing that's going to be able to fix that overnight.
AMH, I just think we have to sit on that just for a minute about how ridiculous that ultimately is. How can you push ESG for years and then tell the oil companies that they need to build refiners at the same time openly discuss taxing them and their profits down the road? Can you just explain that for everyone? That doesn't make sense.
Well, you bring up another point, which is the potential that there could be legislation, which they would need all Democrats to sign on board of this in the Senate, to tax excessive profits of these gasoline companies and oil companies. And you heard the president say that last week. Exxon makes more money than God, and he's going to prove how much their profits are. We're going to go out after them.
What does that even mean? Apple makes more money than God. Are we going after Apple now? They're basically a cash machine. These kind of snarky remarks at the end of speeches about pay your taxes and all this stuff, who's that for? Is that just for the base ahead of the midterms, or is this about setting policy? So it's about politics and not policy.
Well, it has to be about politics, right? Even when you look at potentially taxing these, quote, excessive profits that the Democrats are talking about from oil companies, because they are dealing with this inflation and they are dealing with a reminder every single day to American consumers that a gallon of gasoline is at a record, and it's the highest it's ever been, north of $5 a gallon. This legislation, Jonathan, wouldn't even come into fruition, wouldn't even happen until potentially the fall. So you already see that this is just about messaging ahead of the midterm elections, because the supply and demand story is not going to change overnight. Even if President Biden takes this trip to Saudi, which we know he is, that will not change it overnight.
Yeah.
And especially when you see the report today coming out of the IEA, they are going to be higher prices for longer, because they say this is a problem that is going to last well through 2023.
MH, thank you. Anne-Marie, down in D.C., a difficult moment for this administration. Brian Nixdale with us. Brian, for the energy players, something stands out to me that I can't quite see evolving in the same way as some people. Can you have a scenario where global growth rolls over, something everyone is very pessimistic about, looking forward to happening, and not optimistically so, at the same time as energy equities continuing to rip? Do those things stack up? Can you reconcile those two views?
Only if the slowdown is very mild. Interestingly, what we saw in the retail sales data this morning is that people bought about 4% more gasoline in May than they did in April, and gasoline prices were about 4% higher in May than they were in April. So it's sort of a perfect, correlation between the rising prices and how much people were buying. If there is that inelasticity with respect to how much people are spending, then yes, in a softer environment in which purchases of other types of things are going down, gas and energy generally can hold up relatively well. But I think in a more severe scenario, which I think is more what people are forecasting, if we have, a hard landing, it's hard to imagine there isn't going to be enough demand destruction among energy users that you're not going to see global demand go significantly lower. Every time we had a China lockdown news, we saw the oil price dip a bit, even though we weren't getting, I think, a full picture of what was happening over there. If you see U.S., Eurozone, UK, Japan going into some kind of recession, then I don't think we're going to be at $120 barrels of oil, and energy won't be the leading sector.
So, Brian, I went through the most crowded trades right now in the Bank of America Fund Manager Survey. One was oil, the other was energy equities. And you're comparing two different asset classes, Brian, when you do that. You're comparing a physical good, supply demand clears at spots, to an anticipatory asset class, equities. This is something Goldman has done a lot of work on. And Brian, at some point, you'd fade the move in energy then. Is that moment right now, given we're already off our highs year to date anyway?
I don't think we want to be underweight energy, but if you have profits in energy, which is probably the only place you do have profits this year, taking some of those and redistributing it into maybe a more defensive mix of stocks, maybe taking a flyer on some of these growth stocks, not the ones that don't have earnings, but the established companies that have gotten really beaten up this year. If we do end up with that softer landing or just a normalized economy that looks more like pre-pandemic, then we know those stocks are going to continue to deliver earnings and deliver returns for shareholders. So distributing it more, I say, not being underweight energy, because I think there's still too much risk around the price in the near term, but being more distributed in terms of where the returns are going to come from.
Brian, final word, final question. Just ahead of the Fed a little bit later, this narrative about the Fed going big and that restoring confidence. If the Fed went big today, 75 plus, let's call it 100, would that scare you off? Is that a market you run away from or a market you buy?
No, if they went 100 today, I think you'd see a little bit of a panic in the near term, but I think things would settle down pretty quickly, and there would at least be a sense that we're not going to have a runaway inflation. So that scenario where we have an overheating economy and interest rates to the moon probably gets taken off the table, and that's enough to see a little bit of a relief rally in stocks. It's more of what we saw, just the last 2 months until the last few weeks, with the inflation concerns coming back in. So it doesn't take the recession risk off the table, but I think it does take the rates to the moon risk off the table.
Brian
So
Nick.
I would be a buyer.
Nuveen would be a buyer. Brian, thank you, buddy. As always, looking forward to the Fed special coverage coming up a little bit later, of course, 2 p.m. Eastern time. The decision, 30 minutes after that, we'll hear from Chairman Powell. Coming up, your trading diary from New York City. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
25 minutes into the session, equities higher by 1.3% on the S&P, on the Nasdaq up by 1.5%. Going into the Federal Reserve a little bit later this afternoon, a lot of the refreshed calls we've seen going into this one, looking for a 75 basis point interest rate hike. That's the price action. Here's your trading diary. The focus on central banks. The ECB President Christine Lagarde scheduled to speak at 12:20 Eastern this afternoon. Look out for that. And then it's the Fed's turn. A rate decision at 2 p.m. Eastern time, followed by Chairman Powell and a news conference at 2:30 Eastern. The Bank of England out with a rate decision tomorrow morning. Looking forward to that alongside jobless claims too. And finally, we round out the week with a Bank of Japan rate decision on Friday as well. Is that enough for everyone? More still to come from New York City. This was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away. Because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
Okay, ladies and gentlemen, as you can see, we opened new position for Bitcoin. The price will open at 21,180. Okay, all of you guys, 21,187. All of you guys who decided to follow my trade and trade Bitcoin today, stay with me. We'll close this trade in profit. Okay, and I'll speak to you later, guys. Well done. Good.
Financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind. but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
Usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gauli Doddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that whoever is interested in whatever activity they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city, and and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good